Good. Okay, good morning, everybody, and welcome back, old faces. Welcome, new faces, to this year's Yale Area Annual Conference. We got a pretty packed-in program today, so I want to get started on time. This morning, we're going to focus a lot about the state of the capital markets, hopefully bring some certainty in what's been an uncertain world. And we'll have lunch at the Lawn Club today, and then the afternoon explore a pretty inspiring story of entrepreneurship, explore the Yale Schwartzman Center, and then tackle some big issues in affordable housing and ESG. So, and we'll have some time for networking as well. We have about 200 people registered today. It looks like you all are the early birds here for the first talk. Before we begin, I just want to thank a few people. Allison Bowen right here is the head of Yale Area that makes all this possible. And is Hara here today, or here in spirit? Isabella Duenas from ICF sponsors this program. She's out front registering all of you. ICF's been a huge supporter of us. And then in the back is Purnima Vupaluri, who's my colleague at LCP. Everyone should have a colleague like Nima. People ask me, how do you do this with everything else going on in your life? And that's the answer there. I don't really do anything but show up. Nima handles all of it. So please thank her when you see her today. So let's get started. Our first speaker is Andrew Metrick. He's the Janet L. Yellen Professor of Finance and Management at the Yale School of Management and the Director of the Yale Program on Financial Stability. Professor Metrick's current research and teaching is focused on financial stability, including the regulation of systemic risk, the activities of complex financial institutions, and the causes and consequences of the financial crisis of 2007-2009. I took Professor Metrick's course on that when I was at SOM. I actually got a distinction, which I think just means I showed up to every class. But please welcome Andrew. This will be a great way to start our day.
Thanks, Francis. You have to do more than just show up to get a distinction, just so you know. SOM's a very serious place. Francis did really well in the class. So I'm going to talk about, I think the title is Banking and Commercial Real Estate Excellent in a Post-SVB World. And thanks for the opportunity to discuss this topic. It's something I've been thinking a lot about over the last 6 months. And I'm hoping that this can be very interactive. It's early in the morning, so it's easy for people to fall asleep if it's just me talking. So feel free to interrupt me at any time you want. Just raise your hand. I'm hoping that there will be lots of Q&A. I don't have slides. Right? I'm going to just talk. I hopefully will be able to see your name, although my friend Mike is putting the lights right in my eyes, so I can't see anything. But if I don't see a hand up, maybe, Francis, you'll see it from where you are and can help me. All right, let me just start with just some facts on this topic. Commercial banks have about $3 trillion, or the banking system has about $3 trillion of commercial real estate on balance sheet. Okay, and roughly 2/3 of that is held outside of the largest 25 banks, making it really quite different than a lot of other things that are large bank dominated. We've got, this is a regional and community bank business mostly. And for banks less than, for the smallest banks, for banks less than $10 billion, it can rise to about half of their balance sheet size. So there's a lot of commercial real estate. It's just a big piece of the community banking world. And overall, it's a very significant number. This is about the $3 trillion that's on bank balance sheets is about 60% of the CRE lending total that's out there. 60% of it is sitting actually on the bank balance sheets. Doesn't even get it intermediated off. It's not going into CMBS, but it's actually staying there. So it's it's a very significant business for U.S. banks. And U.S. banks have had a weird year, or weird 2 years, I guess I would say. It's become much more apparent in this year. So the overall question is, well, what does that mean for CRE, and what does it mean for banking? The feedback there, because we know that the CRE has some special challenges, especially the office sector now. So let's do that now. First, this says for the post-SVB world, so it's important to understand what happened to SVB, which is a symptom and then an extra exacerbator of a problem that they didn't create. They were just the SVB and Signature and First Republic that came after them were just the worst offenders of duration, what we think of as duration mismatch on bank balance sheets. But I should put mismatch into quotes. So Silicon Valley Bank, they essentially during the pandemic, like many banks, but particularly those in the tech sector, which was doing quite well and which had a lot of cash, they received a tremendous amount of inflows of deposits during that time. So they basically tripled the size of their balance sheet from little under 70 billion to about 200 billion from the end of 2019 to the end of 2022. So there's a whole lot of inflows. There wasn't that many places to invest the money. During that time, during COVID, there wasn't a huge demand for loans and new investment. So they put most of it into government bonds, right? Governments and agencies. And they went a little bit far out on the curve, not that far out. Maybe they had an average duration of about 5 years on their bond portfolio. If they had gone just for 3 months, they would have earned zero. And even as low as they were paying on their deposits at the time, they wanted to earn more than zero, and they went a little far out. Now, most people, when they look at that situation, think, well, they were kind of crazy. They had a very big mismatch in their book. They had long duration assets and deposits. They were almost exclusively deposit financed. That, of course, though, is banking. That's what banks do, right? So it's not an unusual thing. And in general, the reason that banks exist in the form that they do, where they're taking in deposits that, in principle, people could take out right away, and they're putting it into longer-term loans or buying securities, is because the deposit base of banks actually has, in reality, a much longer duration than you might think. Deposits tend to be sticky, right? People don't take their money out of banks. In general, even though they don't tend to take their money out of banks all that quickly, even when interest rates go up. And if you had asked people at Silicon Valley Bank, isn't this crazy? Isn't it the case that you have 3, 4, 5 year duration on your loan book and on your bonds that you have purchased, but yet you have all these deposits that could fly out tomorrow? They would answer, our customers love us. Who else can take care of these people and look at all our data on how sticky our deposits are? They would essentially answer, we're hedged. Okay? Don't worry about us. We're hedged because our deposits aren't going to move that fast. All right. Interest rates then go up around starting in early 2022, and eventually we see, say, 5% approximate increase in the policy rate, including about 3 percentage points increase further out on the curve, where most of their stuff is. And we don't have to go into all, the specific details of what made people eventually get nervous about Silicon Valley Bank. But if what you do is just mark to market the asset side of their balance sheet, they are insolvent as of the fourth quarter of 2022. Okay, they were insolvent if you just mark the asset side of their balance sheet 6 months before there was a run on Silicon Valley Bank. And this was known. This is not a mystery to people. They put it in their SEC filings. So everyone knew. There's not a run, though, until March of 2023. And why not? Because effectively, people believed the story that Silicon Valley Bank believed themselves, which is, yeah, you're marking to market just the asset side of our portfolio, not the liability side. But actually, when interest rates go up, our deposits, the liabilities that we owe, in some sense, there's a value to those things for us. Because in general, we get to just pay people very low amounts. Even at the end of 2022, half of Silicon Valley Bank's deposits paid zero. Okay? End of 20, half paid zero. So they're thinking, this is wonderful for us. Okay? And indeed, for the largest banks in the United States continue to benefit from this. The 5 largest banks in the United States, I think I just saw, because they just reported third quarter earnings, they earned $34 billion in the last quarter because they're still paying on average. I mean, Bank of America, that's where I bank. On my savings account at Bank of America, they will pay me 1 basis point. That's what I get in savings. So for the first time in a really long time, I've actually sat down and started moving my money to money market mutual funds because they won't pay more than 1 basis point. You call them up, you say, I'm a really good customer. They say, great, we don't really care. Okay, you get 1 basis point. So it's wonderful to be a bank now. This is the best business in the world. Interest rates have gone way up. You can put it in and get other things, and you only have to pay people if you're Bank of America, 1 basis point. So people believe the SVB story. Nobody is going to leave our bank. They love us. We're the only place that really understands their business. And then in March, they announce, we just sold a bunch of securities at a loss that we weren't really ever planning on selling. And suddenly, people say, maybe their customers don't love them. Maybe people are actually taking some money out of their bank right now for a whole variety of reasons. And that led to a cascade where suddenly people said, well, they're insolvent if they're not actually going to make all that money on the deposit side, if people are actually taking their money out. And those things can quickly turn into runs, and that's what happened. Okay, so that's sort of the basic thing. Their effective confusion wasn't that they didn't understand that they had a duration mismatch. All banks have a duration mismatch if their deposits truly leave them tomorrow. It's just they thought their deposits wouldn't leave them tomorrow. Right? Now, Silicon Valley Bank is simply the worst offender of a broad problem, of the broad existence that in the entire banking system of this. And if you do calculations of how big the hit was to bank balance sheets during the year plus when interest rates were going up, you will estimate that if banks had about $2 trillion, the overall banking system had about $2 trillion of capital and of equity at the beginning of 2022. And on paper, if you only mark to market the asset side of their balance sheet, they lost about half of that, at least half of that. Okay, that has not, primary thing to keep in your head here is that has not gone away. Okay, so they started off capitalized with $2 trillion of equity and feeling pretty comfortable collectively for the whole system. And they have, if you were to just mark to market to the best of your ability, the asset side of their balance sheet, they lost at least half of that. Okay? And regulators know this. Everybody knows this. What does that mean for the banks? Well, in general, for some banks, they think, yeah, okay, you mark to market the asset side, but we are killing it on the liabilities. We're killing it on our net interest margin because we don't have to pay people that much anymore. So really, we're fine. And that is true of the largest banks in the United States. After the Silicon Valley Bank and Signature and First Republic runs, though, there was a lot more pressure on the banks other than the very largest banks. The very largest banks have this implicit, they're too big to fail. The government would never let them go out. Everybody started running towards those largest banks when they got nervous about Silicon Valley Bank. That is not true of all of the banks kind of below the top 25. Those banks faced pressure. They suddenly had to start to pay higher amounts on their deposits, or they were seeing deposit outflows. One of those two things. Okay? And so the interest rate increase then did two things to those banks. It hit the asset side of their balance sheet to the order of at least half of the capital that they had before if you market to market. And it was no longer the case that they could easily expect to earn their way out of it. Okay? For instance, the Federal Reserve, the Fed, created a special emergency lending program for banks, which gave much more liberal rules in how it would in how it would haircut and value the collateral it received for loans. But the Fed charged, the policy rate to make those loans. So a bank would lose its deposits that it was paying, between 0 and 1% on, and suddenly find it had lost deposits. It would go to the Fed and say, hey, here's some collateral, please replace those deposits for me. And the Fed would say, sure, but it would charge them 5%. And on the collateral, they might be only earning 2%, for example. Okay? So banks so not only is the banking system kind of taking a hit to the asset side, but their earning power, and again, we're talking about not the largest banks, but everyone else, which is the group we care about for commercial real estate. Okay? Because those are the ones who have most of the commercial real estate. So they're facing pressure on their ability to earn, and they've been hit on the asset side. That's kind of that's the state of the world post-SVB, and that has not alleviated because the long rates have not come down. If anything, they've gone up a little bit more. Okay, from first they dipped a bit after Silicon Valley Bank, but they've come back up and they're even higher than they were before. Okay, so that reality exists right now. Okay, so let's go before I go on I'm now going to talk about what I think the implications of that are going forward, both for CRE and for financial stability. But before I do that, any questions just about that narrative and the state of bank balance sheets? It's too early in the morning for questions. Yes? I mean, you could always get dividends from the bank instead by just taking your money out of your deposit account and buying equity. But that's not generally, deposit accounts provide services to people. And so basically, if you have a deposit account at a bank and the bank calls you up and says, we don't want to, first of all, they're going to pay you 1 basis point as long as they can. If you call them up and say, I'm going to leave because you're only paying me 1 basis point, and you're thinking, well, instead of paying them 4%, why don't we just offer to share dividends with them? That's not something you can legally do while telling them that they have a deposit account, which guarantees them a minimum of $1 back. So that's not a legal security that you can offer them in an insured deposit account. But you could say, hey, why don't you just transfer this over to stock and we'll pay you dividends? But that's generally not what depositors want. Depositors want to get the transaction services of those things. There are mutual savings banks that still exist out there, but it's a very small piece of the world where you'd be earning interest plus you would get a dividend at the end of the year for the earnings of the place. Yes?
So I'm not sure about the bank in New York, but I know that First Republic, Silicon Valley were both state chartered banks.
Yes.
That were regulated by the Fed. Do you think the outcome would have been different in terms of, liquidity standards if those banks were both OCC and Fed regulated?
Yeah. So the regulatory system is tricky, right, in the United States, and you're correct in identifying the difference in that if you're a state chartered bank, your regulator is the local state regulator, and then your backup federal regulator is either the FDIC or the Fed, okay? And if you are a nationally chartered bank, then your regulator is the OCC. So there's been a lot of attention paid towards, did the regulators screw this up? Was there something that the regulators who write the rules or the supervisors who go in and enforce the rules, was there something they could have done that was different? And I don't think it mattered at all who supervised these folks. I think the underlying structural issue is that overall the banking system lost a whole lot because of this mismatch. And I can tell you, having had many, I spent this summer at the United States Treasury, and I spoke with a lot of supervisors and regulators, and they're all really serious people about their jobs, and they all basically have the view that we shouldn't be marking stuff to market on the asset side of the balance sheet. Because we're not doing it on the deposit side, and deposits tend to stay safe. And the OCC, the Office of Controller of Currency, which is would do it if they were national banks, they say that as well. Okay, they have that same view. So I would be really shocked if it had been an OCC bank and somehow they had treated it differently and said, oh no, we're really worried, we're going to be much more aggressive. I think basically this is the system that we've set up. We have decided in the United States, as a matter of policy, implicitly, that we are going to think of deposits as being sticky. That is effectively how banking works. And we've written our regulatory system to take that into account. We do not, for example, look at banks, mark to market the asset side of their balance sheet. No regulator does this. Mark to market it. Say, hey, if I mark this to market, you're insolvent. You better do something about it. No one does that. Okay? So there's various accounting conventions that differ across the size of banks, but nobody kind of thinks of this in that way. And that may not be wrong for historically. We may be entering a new world where people are much happier to move their money quickly. Yes, sir.
How do you feel about that view, not marking balance sheets to market? We live in a world with perfect information and hedge funds and lots of others who know what they're doing.
Yeah. Well, they know what those assets are worth, but those hedge funds are really also very, very savvy. Having spoken to a lot of the hedge funds who invest in this side too, they're really savvy at trying to figure out what the liability side is worth properly too, and marking that to market. So what the hedge funds will think about, for example, they made big pictures after Silicon Valley Bank that has kind of on one axis, here's the mark-to-market losses on your asset side, and on the other axis, here's your uninsured deposits that are runnable, and here's what you're currently paying. And they really dug in to try to figure out who has a lot of value in their deposit franchise.
How does that impact your view of institutional ownership of banks, then? Like 25 or 10%? You don't want institutions to own banks.
Institutional ownership of banks or institutional deposits in banks? Well, the institutions own everything in the United States. I mean, the retail investors' direct investments now are a very small portion of the stock market. So it's not, I mean, retail investors are mostly intermediated through.
Nobody wants to become a bank holding company with anything else. You're over 25%, your life is part of the OCC.
I think I'm going to have to talk to you offline about this. It seems like a bigger question than one that I can answer from the stage. Yes?
If I'm correct, the Fed or whoever, the federal government covered all the deposits, including the technically uninsured.
At Silicon Valley Bank and Signature. That is correct. Not at First Republic.
So if the policy is, we all know this is going on and we don't want runs on the banks, they just took away the $250,000 whatever limit is applicable. Would this situation solve itself?
Well, this situation would solve itself. Another one would become a problem. So what post SVB, the FDIC wrote a report and said, here are our options. And one of the options is let's get rid of the cap permanently on deposits. And that would certainly make the banking system safe. It would also create enormous incentives for the banking system to effectively create products that were insured but risky. So if you had a way to say, I'll take your money and and it's perfectly insured no matter how much of it you give me, that's a pretty dangerous situation for clever financial engineers. And so that's the concern that people have. I mean, we recognize there's always a balance between the moral hazard of insuring someone and the fact that we know that depositors in general aren't really good monitors. They just run. So we would try to balance that. Now, I would say an important part of your question is, yeah, but we're doing it anyway. So shouldn't we just admit it? And I think that's the challenge that we have. We're not completely doing it. You know, in the case of First Republic, which was the last to go, We were lucky. JP Morgan bought them. If JP Morgan had not bought them, it's not obvious that we would have been able to. You have to flip a switch to cover the uninsured depositors. You need a certain amount of votes and support to do it. And it's not clear that support existed. I mean, the uninsured depositors in First Republic might have been on their own. And because of that uncertainty that's still out there, that's part of the reason people leave those banks and go to the big banks. So that's still there. Yes, I'll take one more and then I'll go on because I want to make sure I talk about commercial real estate. Yes.
Two banks are hiking in the woods and a bear market goes after them. They have a moment where they have to decide whether one guy throws down and tries to outrun the other one or they fight the bear market. We're at that moment. What do you think is going to happen?
It's a really hungry bear. It can eat both those hikers, right? You know, it'll eat one of them and then it'll be really excited and it will run after the other. And that's basically what happens in a bank run. Or the smell of blood attracts other bears. So the only thing that can happen there is for the federal government to come in and do some emergency lending to those hikers, right? Which is sort of what happened in the end. But we still have this situation overall where the balance sheets have received an insult, and the earning potential going forward has received a pushback. So let's now go to the next steps. Okay? So that we've been in that situation for 6 months. Compared to 6 months ago, 7 months now, it looks that the next thing you worry about is something cyclical, like a recession. March represents an actual honest-to-goodness banking crisis. So when people economic historians look back on March, all the definitions that we have in economics, technical definitions of whether a banking crisis happened in March. That doesn't mean every banking crisis looks like the global financial crisis. It just sort of has certain technical things. Those levers got pulled. Okay? But that happened outside of a recession. Really rare. Really, really rare. Usually it's credit losses that do that to us. Okay? And in this particular case, it was not credit losses, it was the duration. Right? The interest rate book that did it. That's an unusual thing. Right? And that's because in the United States, we've never had interest rates go from 0 to 5% before. We've had larger increases in interest rates, but they were starting with a higher base. Right? Paul Volcker made interest rates go up by a lot more than that, but it started at a higher base, and bond math is such that if you start at 0 and go to 5, you take a huge hit. It's like 15% hit. And we never had something that large before. So what happens if we actually get a recession and cyclical bad stuff starts to happen to bank balance sheets? Okay, that's the real concern. Things look better, especially given yesterday's, nearly 5% GDP growth number. We're not in a recession now. It looks less likely that we will have a recession in the next 12 months than it looked 6 months ago going forward. But we're certainly not out of the woods, and there's plenty of people staring at the recession indicators saying we still think it's going to happen. Okay, so we're not out of the woods for starting to get credit losses. If we do not get credit losses, if we manage to avoid a recession and get a soft landing, the banks will recover. Okay, we will not have further problems in the banking sector, and eventually they'll take a deep breath, and interest rates will eventually normalize. And the world, we're not going to go back down to 0 interest rates for a long time, but the world will calm down. But we're not out of these woods because of that. So that's sort of the cyclical thing hanging over us, and that's the thing that keeps, Jay Powell up at night, is what if inflation doesn't come down, as it hasn't so quickly for a variety of reasons, I have to keep interest rates high, and we actually start seeing a recession and credit losses. Historically, for every 1 percentage point increase in the policy rate from the Fed, banks take 1% hits to their capital over the next 8 quarters. Okay, so usually that's what the Fed's trying to do. That's a feature, not a bug, of raising interest rates. They're pushing back on the economy. It usually causes losses. So if they made interest rates go up by 5%, you kind of expect 5% losses to capital and if they lose 5% of their capital, there's going to be a lot of banks in trouble. Okay, and so that's the nervousness that goes forward, which is why you're not going to see banks changing their approach and their outlook towards their main lending categories like CRE. Okay, in the short run until we know we're out of the woods or interest rates come down. And interest rates won't come down until inflation comes down. Okay, they're going to hang on. Okay, so that's a cyclical thing. Now let's turn to the big beast, which is the structural thing. I've gotten almost through the whole thing without talking about the main structural problem, which is the thing that you will all know much more about than I do, which is COVID has really changed the environment for commercial real estate, particularly the office sector. So office is a little less than 20% of CRE. And the last that I looked, maybe it's changed since then, but the last that I looked, the swipe card data for offices has stabilized at about 50% of its pre-pandemic level. Okay, so it went up, people started coming back to the office, and then it really kind of leveled off. We don't know whether that's going to change. 50% of the people who were swiping into the office are swiping into the office now compared to pre-COVID. There's ain't no way we're going to keep the same amount of commercial real estate in that world if that stays steady. Okay, so that's the structural thing. We've had a change, perhaps permanent change, in the usage of space. Okay, and the people in this room, my friend Michael Schaefer can probably explain to me, how hard it is to convert stuff from office to other things. That's the expensive piece. Okay, and so that adjustment will be difficult. In the next 4 years, roughly 2/3 of the office CRE needs to be refinanced. It will need to be refinanced at significantly higher rates. A lot of that stuff just isn't going to work. The math isn't going to work at those higher rates. Some of the industry expert analyses that I've read suggest that, properly measured, we're down about 30% or so in the valuations that we would see in this part of the sector. That means a lot of this stuff is going to end up needing to be worked out. So while the snake is digesting that elephant, it's going to be a very difficult environment to be getting loans from the institutions that typically give these loans. Right? And that's sort of that's the bottom line on banks. So they've got this interest rate problem, which is still here. They're still facing uncertainty about the cyclical stuff, which would be very dangerous if it gets bad. Looks better than it did 6 months ago, but not out of the woods. And then we have this structural adjustment that we pretty much know is coming. Okay? So let me leave you with one thing that keeps me up at night. That makes me a bit nervous about CRE and banking and their interplay, which is that when I talk to bank regulators, their view on this is very informed by past commercial real estate downturns, which are slow-moving things. They don't tend to lead to immediate crises. We spent 10 years after the global financial crisis working out a whole lot of commercial real estate problems that existed. And they existed. They didn't have this structural component that we have from post-COVID, but that's really mostly affecting just the office part, the office thing. And they take a long time, and they're spread out over thousands of banks, and it doesn't seem to be a systemic concern. It's not the kind of thing that gives us a Lehman moment, where all of a sudden it makes the system overall collapse. I study financial crises, so I worry about those things. I try to think, what are the things that can go wrong? And there's one important change that has happened over the last 10 years that might make this commercial real estate downturn, if it happens, so we have to have a recession to make stuff happen quickly. But if it happens, that would make it really bad, which is we now have a new accounting standard for banks in the way that they're supposed to deal with their loan book called current expected capital losses. Is capital current CECL, okay? And the difference here is that in the old days, a bank would just leave things on its balance sheet as long as the loan was performing, okay? And so think about the commercial real estate loans that are approaching the time when they need to be refinanced. If it's currently performing, and we've seen some uptick in loans not performing, but not that much, in part because a lot of these loans are still paying 1% or something like that. So the banks wouldn't have to change the way they handled it on their balance sheet. If these days, though, with our new rule, banks are supposed to take seriously what they think the probability is of something paying off in the future, even if it's current today. And that particular adjustment, if you're really going to take it seriously, means that you should be looking at some of these loans and saying, I don't think we're going to be able to refinance this loan. We're going to take some losses on this loan when we have to refinance it. There has been not that much additional provisioning, even though this rule has come into place. Early in COVID, the banks did a lot of provisioning. They took most of that back. Okay? They've started to add a little bit more, but not that much. So my nightmare scenario is the following. Okay? This whole thing is governed by the accountants, not by the regulators. So just imagine for a moment that whatever the bank is in the United States that is furthest out on the curve, the Silicon Valley Bank of commercial real estate, that's furthest out on the curve and in the most trouble, they fail. Somebody is going to be the worst. Okay, and let's imagine the worst fails. So kind of the bad stuff that happens. Whoever's most exposed ends up, and then it's like a $25 billion bank, not the biggest bank in the world, but it happens all of a sudden. Okay, so you know immediately after that we have congressional investigations. Everybody talks about what's going on at that particular bank because we have to figure out why that particular bank failed. And what we discover, because it's true of all the bank balance sheets, is we go and we look and we see, why hadn't they provisioned for this? There's very little provisioning going on. Why? I mean, suddenly we're seeing that all this commercial real estate had gotten into trouble. I look a quarter before, they weren't even telling their shareholders that this was going to happen. They got it wrong. Okay, that next quarter, every accountant in the world is going to tell their banks, I'm not going to be the one blamed for you if you fail. And they're going to get very tough on the CECL standard. Okay? And so what looks like a slow-moving disaster suddenly crystallizes as a expected value disaster that everybody has to put on their balance sheets at the same time. And then suddenly the whole world looks out and says, I got 500 banks that are insolvent on paper if they do this. Right? That, to me, is the nightmare scenario, and we are at risk of that happening as long as interest rates stay high, and we've taken that punishment on the balance sheet, and so many banks kind of sit near the line. So not to leave you being super scared, but you should be at least a little scared, because I'm a little scared. Okay, and I think I'm out of time, so thanks very much. Thank you.